Hello friends, I welcome you all to the sixth session of our 8 session series on the comprehensive approach to FEMA, organized by Committee on Economic, Commercial Law and Economic Advisory of ICAI. Today's session is on compounding of offenses under FEMA, and for the session we have our very learned friend CA Tanvi Boraji. I'm sure participants will have many questions on the topic. I will request participants to put all their queries in the chat box. And for the time being, keep yourself on mute mode. We'll take up all the questions at the end of the session. As regard our learned faculty today, for the people who don't know Tanvi ji, let me introduce her. CA Tanvi Vora ji is a qualified chartered accountant and a lawyer with experience of over a decade in providing services under Indian foreign exchange law, transfer pricing, and international taxation consultancy. She holds advanced diploma in international taxation from Chartered Institute of Taxation, UK, and also done advanced LLM program in international tax law from University of Amsterdam. She is currently working as director, tax and regulatory at Hardik D. Mehta and Company. Earlier, she was with PR Bhuta and Company as partner. She has also worked with KPMG India in their transfer pricing team. She is also serving as a convener for the Membership and Public Relations Committee of the Chambers of Tax Consultants India for the year 2021 and 21-22. As regards the recent topic or the current topic under discussion today, I must highlight she has co-authored the publication titled FEMA Compounding Orders, a comprehensive analysis published by Bloomsbury, India in July 19, and as well its second volume, which got published in October 2020. It goes without saying that she's a regular speaker at various forums and has published a number of articles on the related subjects. With this, I, on behalf of all the participants and team ICI, welcome you for the session, ma'am. Over to you, Tanvi.
Thank you so much. Thank you.
Tanvi, can I take 1 minute since I have joined?
Sure.
Thank you so much. And the basic reason of joining is to hear you. And when I saw, good afternoon, friends. Good afternoon, Susil. Good afternoon, Tanvi. Mr. Yes, how many members are viewing the webinar? Can you give the statistics in the chat box? Friends, today is a 6th webinar on FEMA, and happy Eid, happy Akshaya Tirthya, and such a wonderful day, where unlimited wealth for professionals, unlimited wealth comes when there is unlimited knowledge, because knowledge is money for us. And we have heard Susilji earlier. We will be hearing her, Tanvi, today, and the credential itself are so much. So I want each one of us to take interest in this subject, which is a very lovely subject. And 60 hours to 80 hours, my study will give a more than reasonable confidence on this topic. And compounding is a very important process. We have section 13 where penalty is 3 times the amount involved in the transaction, and section 15, which is the compounding, in 180 days it happens. So over to you, Tanvi.
Thank you so much, sir. Thank you. I just share my screen with my presentation.
Mr. Yes, make everyone co-host. Krishnakant and Rina, yes, you are there. Thank you.
It's in full screen mode, right?
Yes, Tanvi, yes.
So before I go into the main presentation, thank you, Sushilji, thank you, sir, for inviting me to this session today. It is really an honor for, giving us upcoming junior artists, an opportunity to speak at the level of the ICAI. and it really pushes us to do better in our own field that we have been working on. And thank you very much, sir. The way you have been pushing a lot of us. Thank you, and so hats off to you for all your hard work and your dedication to the field, sir. So coming to the topic of compounding that I'm going to be covering today, just to give a little bit of background on how I'll be doing breaking the session up. I plan to first cover maybe about 30 to 35 minutes on the actual process of compounding, how we will, how you undertake compounding, what is actually compounding and why it has been doing, and why we are actually having a separate topic when we do a session on FEMA. And after that, I will cover the rest of the session, maybe the next 1.5 hours on some of the important cases that we've come across when we did the analysis of the compounding orders that were published by RBI. Mind you, there were more than 2,000 plus orders that we had to go through. And if I try to cover most of the important ones, actually a lot of the important ones, I think we'll be here till night. So what I've tried to do is covered mainly FDI, ODI, and some of the ECB topics. The others are important. I'm not saying they're not, but there are very few cases on that, and many of them are self-explanatory. So, or maybe we could have a separate session if the time permits at a later date, where I can cover those topics. Again, breaking up, I haven't done an exact statistics, but breaking up the numbers out of the many orders that are there, probably you'll find 80 to 85% of the orders are on FDI. Maybe another 15-16% are on ODI, and the rest of the minor percentage that is left will be on the other topics that are ECB, lending, borrowing, exports. There'll be like, there are a total of maybe barely any orders on exports or imports, etc. So this is why I thought I'll mainly cover ECB, ODI, and FDI. Also, I am going with the assumption that since we already had so many sessions that have happened in this batch itself, the participants are aware of at least the background of FDI and ODI. So I will not spend time on actually explaining the regulation. For example, when ODI was covered, the speaker would have covered when do you file Form ODI. So I would not wish to spend time explaining what is the regulation behind filing of Form ODI, how many days are required. I will spend maybe 2 seconds on it and explain this is the section, this is the time limit. But I don't want to go into the intricacies and spend a lot of time, because then that way again we'll be here till night. And I've been clearly given a time limit of 2 hours. So getting into the entire topic. Just a second. Sorry. So what is compounding? Compounding is when in FEMA, compounding is compounding of contraventions. And then you come to the question, what is a contravention? A contravention is a breach of a provision of FEMA. And like would have been explained by so many of the speakers before, FEMA does not only mean FEMA Act 1999. FEMA includes the FEMA Act 1999 and all the attached rules, regulations, notifications, directions, circulars, everything that's issued by RBI. So everything under the face of FEMA, any contravention of any of those provisions is considered a contravention. So what, again, going back to compounding, compounding is a voluntary process where you admit that you have actually made a mistake. You are pleading guilty. So this is separate from a litigation process where we go in a court where you actually fight the process, where you say that, no, this is not what I have done, this is what I have done, etc., etc. Here, you are pleading guilty. This is what mistake I have made. I am accepting my mistake voluntarily, and I'm asking you to compound my mistake. That is the layman's explanation of compounding. Why we are analyzing these compounding orders and how we came across analyzing these compounding orders is because RBI in 2016 opted for public disclosure of all the compounding orders that were passed. This is not a new provision or a new section that came in, section 13 like sir mentioned, and section 13 which provides the penalties, and section 15 that provides the process of compounding. Although, so it was there since FEMA Act came into play, but since 2016, they started, my apologies, they started publishing these orders in the public domain. And that is when we came across the idea to analyze these orders to get an insight into how RBI is actually considering breach of certain rules, how RBI is processing contraventions, etc. And that was the main inclination behind analyzing so many orders. However, what happened was in 2020, RBI again decided to not publish the entire compounding orders. So there was a period from 2016 to 2020 when you had the entire order that was published on the RBI website, which is still available if you go on the website. From 2020, they have a separate page on the RBI website where they do not submit the entire PDF order of the particular applicant, but they only have one-liner summary where they only provide the name of the applicant, the section or the regulation under which they made a contravention, and the amount that was the amount involved in the contravention and the penalty that was required to be paid. Which again, that is the minimum sort of disclosure that they need to make, but it does not help us in any way in analyzing what are the facts of the case or what happened and how it was calculated, etc. So my analysis further, which I said when I've covered FDI, ODI, pertains to the orders that were available between 2016 and 2020. Some numerics, the orders that are available between 2016 and 2020 is 2,364. Since 2020, March 2020 till date, there are approximately 1,000 orders that are available in the summary format that I mentioned. Just a little brief about the compounding orders that are available. If you all have an interest in these orders, you all can go on the website and open a couple of them and see them. They are not very heavy or very heavy in the details provided. They are crisp to the facts that are involved in the contravention. For example, if there is a contravention of a delay in filing a form ODI, it will be crisp to the fact that this is the applicant is involved in this business, it made an investment on so and so date, it filed the ODI on so and so date, therefore there was a delay of so many days. Crisp and short, which is helpful, of course, to us. And like I mentioned earlier, that it provides us insights into the principles that RBI has been applying, how they have been interpreting their own provisions, because FEMA consultants, FEMA practitioners are aware that there are certain rules and regulations that are so confusing and so round and worded so funnily that you really need to have certain kind of clarity, and that's what these compounding orders have been provided. Just to clarify, these orders, similar to what we see in direct taxes, these compounding orders do not have any precedence value. but they have guidance value. By guidance, I mean you cannot go to an in a case of compounding of your client, you cannot go to an RBI officer and say in XYZ case you applied so and so, and therefore only so much should be the penalty. But you can have some kind of guidance or some kind of persuasive value by which you can convince him that listen, according to me, this should be the way this should be interpreted, and this is how you have, or not you, not him per se, but a certain case with similar facts, this was how it was applied, and that is why this is our view, and my suggestion would be if you could apply it in such a way. So it only has persuasive and guidance value and not precedence value, how we generally have our mindset in direct access. So I spent a little extra time on this because it was important to provide a background on compounding. Now going into the specific application, the process, the scope when it comes to applying and of the compounding process. So the scope and powers, and who has the power to undertake compounding. For contraventions of any provisions of FEMA Act, RBI can compound except for two, that is Section 3A of FEMA Act and Section 37A. And they have also given monetary limits, which is monetary limits for based on designations, because that depends on the seniority of the RBI officer involved. These are available. I will not, it would not make sense to spend time on reading out what is written here. So I will go further. But yes, mainly depending on the quantum of the contravention involved, the designation is where is important to be applied of the officer that needs to undertake your compound. The amounts in contravention, that is where penalties in Section 13 is of FEMA Act is involved. If the contravention is quantifiable, the maximum penalty that can be levied is up to 3 times the amount involved. However, if the contravention is not quantifiable, the maximum penalty is up to 2 lakhs. My suggestion for questions would be, once you can any questions relating to procedures and all. Once I'm done with the procedures, you can we can take up those questions before I go into specific orders related to FDI, ODI, etc. So we are clear at that point related to the processes, procedures, etc. Delegation of powers. So again, these powers, so why this is again important from a practitioner point of view is because you have to know where you need to apply for your client, at which RBI office do you need to make your compounding application. So with respect to this list of, there are a couple of slides with these lists of contraventions. I will list out some of the important ones to explain. The application should be made to the regional offices. So there are regional offices in almost every state. And only specific to Kochi and Panaji, they have given a monetary limit. Other than that, every regional office in itself has to compound the contraventions listed here. And some of them are mainly being related to FDI, ODI, such as the delay in reporting inward remittance, which was there under FEMA 20. The FCGPR issue related FLA, a violation of pricing guidelines, issue of instruments which you were not eligible to issue, such as non-convertible debentures, shares with optionality clauses, etc. You issue of shares which were only allowed to be issued with approval, but approval was not taken. Certain other things like transfer of shares and delay in reporting those transfers. Many of them are listed. I would not, because we have many slides coming forward, I do not want to just, read out what is mentioned. If there are specific questions, please feel free to ask questions. Mind you, specifically the regulation 1462, delay in intimation to FIFP of downstream investment. This is something very often many consultants forget, because downstream investment as a regulation in itself, it would have been covered by the person who took up FDI with you. And they would have also mentioned, because downstream investment is something that is very often forgotten. And not only is downstream investment to be reported to RBI through the firm's portal, but it is also to be reported to FIPB through the FIFP portal. So there are dual reporting in that case, and the form is very similar. So, and you would have to undertake compounding for both of them. If there is one is done and the other is not, or both are missed out. So please keep in mind that this should not also be missed out. There is LLP, investment in LLP reporting, etc. FLA reportings. Many of them are reporting related, many of them are pricing guidelines. You might find some of them to be a repeat, but the first list was delegation of powers with respect to FEMA 20. Second was with respect to FEMA 20R, and the third list that will come ahead is with respect to the Nondebt instrument rules. So before I stop here to explain why I have listed 20 and 20R. You might think 20R is no more. The person covering FDI did not even teach us 20 and 20R. But it is important from a compounding point of view, is because compounding, if you realize, is for contraventions that happened in the past. Past could mean anything from 2000. Please remember that in FEMA, you do not have a time limit. How you have either a 6-year, 8-year, 16-year, whatever time limit, how you have in direct taxes, FEMA, you do not have a time limit. It could even, in fact, go prior to, since FEMA came in 1999, you have to even, in fact, have all your documentation in place. Please suggest your clients, if you have foreign remittances, foreign investments coming in, do not dispose of your documents. I have cases I have been dealing with that certain clients, they had thought that now it's been 10, 12 years, they disposed of their files without even digitalizing them. And now we do not have any proof of investments, proof of filing, nothing. And we have to now undertake all the documentation again and undertake compounding again, just because they had done all their compliances, but they do not have copies of the same. That's a simple mistake that was made, but mind you, that was a silly mistake. So just remember, there is no time limit under FEMA. And keeping that in mind, as of today, as a FEMA consultant, it does not mean you only need to know the latest FEMA law, which is the non-debt instrument rules. You also need to have knowledge of FEMA 20 that was there at the time when prior to FEMA 20R that came in 2017, and then 2017 to 2019 when there was FEMA 20R. What could also happen was you would have a transaction or an investment that came in, say in 2010, 20 would apply from 2010 to 2017, then 20R would apply to 17 to 19, and NDI would apply from 19 to present. So you, as a consultant, would need to have knowledge of all three. All three would apply separately to the same transaction. So that's the reason all three are listed under this table as well. And all three continue to apply in the sense that they apply for compounding and they don't apply as of today in the sense for new investments that come in today, but they applied when an investment came in at a particular time in the past. I hope I'm clear in this. If any queries, please feel free to ask. Non-debt instrument here. This list has been broken up into because non-debt instrument rule specifically deals with the substantive regulations relating to FDI, which is the instruments, the eligible instruments, the pricing guidelines, approval route or automatic route, the sectoral caps, etc., etc. Whereas the mode of payment and reporting of non-debt instrument regulations deals with the reporting side, which is still under the purview of RBI, which deals with the reporting side of FDI. Going ahead, which powers are delegated specifically to FED, that is Foreign Exchange Department, the CO cell in New Delhi, that is the notification FEMA 7, which relates to immovable property outside India, FEMA 21, which is immovable property in India, 22, which is branch office, liaison office or project office in India, and FEMA 5, that is the deposit regulations, which I specified the 7, 21, 22, which includes the superseded one, the 7R, 21R, 22, etc. These applications related to contraventions under these notifications would have to go to New Delhi and not the regional offices. So that whole topic or those slides related to where we file the applications. Now, what are the prerequisites before you can even file an application? Before any contravention is done, first and foremost, you can only file an application related to compounding only if a compounding application was not already filed for that same contravention within the last 3 years. So if I'm filing a contravention related to non-filing of, I'm taking the easiest example every time, non-filing of Form ODI. I can only file a compounding application if in the last 3 years the same contravention was not compounded. Biggest and the most important prerequisite is that regularization of the contravention is a must. What do I mean by regularization? By regularization, the layman meaning understanding of that is that the mistake that was undertaken should have been corrected. The mistake could be, if it's a compliance or a filing related mistake, you undertake the filing. So if you had missed out or in a filing, you undertake the filing as on date. If it was an approval that was required to be taken, you take the approval as on date. If you undertook a transaction that you were not allowed to undertake, you unwind that transaction. So for example, round tripping of investments is not permitted. These are not, I will come to an example of that case completely, but in short, round tripping of investment is not permitted. So you unwind one leg of that transaction and that becomes regularization of that contravention. There were earlier classification between technical versus material, and that classification by RBI has been discontinued. Now a contravention is a contravention as long as it has been, so it is in fact now between filing or a substantive contravention versus a reporting contravention. If there is a suspected case of money laundering, of terror financing, or affecting the sovereignty or integrity of the nation, ED, that is Directorate of Enforcement, has the right to proceed with that case. And in fact, it is generally referred to ED. RBI itself refers the cases to ED. You will come across every order where if there is a case pending before an ED, you can't in fact compound a case, a contravention before RBI. So every case, RBI generally asks ED for approval that this applicant has come to us. Can we compound their case? Do they have any pending cases before ED? And this is important because if there is some money laundering, some terror financing, anything involved, it is a serious offense, and this needs to be kept in mind. So who is an applicant? Applicant is the one who contravenes the provision. And this is important. I have made a mistake. I apply to ED. If, for example, I have transferred shares and I did not file the required compliance or the required form of Form FCTRS, I need to apply to RBI to compound the contravention. My consultant or the company on my behalf cannot go and apply to RBI. So this is an important point and a definition of who the actual applicant is. It depends from contravention to contravention, which regulation is actually being contravened and for what regulation the compounding is being undertaken. So this is sort of a bird's eye view of the compounding procedure. We undertake a filing of the application. This application is examined by the RBI. If there is any additional information required by the RBI, if any certain documents are required by the compounding authority, they will ask for it. You have a compounding hearing. I will explain further. The compounding hearing is optional. You can either opt to attend the hearing or you can opt out to attend the hearing as well. Like I mentioned in my first slide itself, you are in the first place, compounding itself is accepting that you have made a mistake. So if you have anywhere accepted that you have made a mistake, there is actually nothing to go and sort of litigate or discuss or sort of fight or have a to and fro with the officer that no, I don't agree with you, this is not something that I've done, etc., etc. So you can even very well opt out of a personal hearing. So you have a hearing. Based on the hearing, either you attend, either you don't attend. Based on the documents submitted, the amount of compounding fee is decided and the compounding order is issued by the RBI. Within 15 days of the compounding order, the compounding fee is required to be paid by the applicant. And once that fee is paid, sort of an acknowledging slip is paid, certificate is issued by the RBI that the order is issued, the amount is received, and therefore compounding is complete. What forms part of the compounding application? There is a format of compounding form prescribed under the compounding proceedings rules. You also have an annex to the form, and depending on what the contravention is, the contravention could be related to FDI, ECB, ODI, LOBO. Depending on that, you would have to fill in details as an annex to the form, depending on the category of contravention. You also have to give an undertaking that you are not under investigation from any of the other agencies such as Directorate of Enforcement, CBI, etc. And although you give this undertaking, generally there is an internal procedure that is undertaken where the RBI themselves ask for an NOC from the ED or the CBI that whether can we go forward with compounding for the so-and-so applicant. You also have to submit, these are normal procedures, but as a session on compounding, I thought I listed down. You have to also attach duly filed the ECS mandate. You have to attach a cancel check copy of an MOA in case it's a company as an applicant. Of course, if it's an individual, you don't have an MOA. The latest audited balance sheet and the contact details of the applicant. And in case you have an authorized official or a representative or a consultant, details and of that consultant as well. If any of the details are missing from this list of this, RBI generally returns these documents back and gives a time limit to submit these the required or the missing details. But if those details are not submitted on time, the application is considered as never being submitted. So it's very important to have all the documents in place. But in any case, they are lenient enough to provide you a little bit of time in the worst case scenario that something is missing. I already covered this, that personal hearing is optional. The personal hearing can be attended by the applicant himself or by a representative or by a consultant or lawyer or CA. It is not like a high court where the person has to be an advocate. It can be any person having, there is no minimum requirement of any qualification. But of course, it's preferable either the person himself or someone having knowledge of FEMA. And it does help if that person has knowledge of FEMA, because that way at least the right regulation is being followed. Sometimes mistakes can happen even by an officer when a certain contravention or a certain transaction is not interpreted correctly. A person can even opt out of a personal hearing and the application is disposed on the basis of the documents that are submitted. I think this slide has come twice. Certain other points I just thought I'll cover here is that the order should be issued by RBI within 180 days. That is the legal norm. But since the time of COVID, especially since the time of COVID, there were times, in fact, in between about 9 to 10 months that no compounding applications were being processed at all. And after that too, due to backlog, the 180 days is not being adhered to. But I mean, due to COVID, I think the world has been upside down. I don't blame them. But things are getting back to normal. Maybe if not 180 days, 270 days is at least being adhered to. There is no provision of appeal against a compounding order. And why no appeal? Because anyway, in the first place, it is a process of accepting a mistake. So if you're accepting it in the first place, there is no question of appealing your approval. And I already mentioned that once a compounding order is passed, you have 15 days to pay the compounding fee. So the compounding fee that I keep mentioning multiple times, how is this compounding fee calculated? Until the actual guidance was provided by RBI, and until we actually analyze some of these orders that came into the public domain, this was a complete question mark in the eyes of the consultants. We had no idea what was happening in the background, and this was a real welcome move by the RBI of making the matrix that they have available to the public, and by that, suo moto, multiple applicants suo moto approached the RBI saying that we have realized that we have not undertaken this filing, for example, or we have made this contravention and we want to cut off at this point, because if RBI, if you come to know today that you have not complied with so and so rule, you rather cut off today and you accept today that you have made a mistake and you pay your compounding fee up to X date today, which could be 5 years, rather than when RBI finds out maybe another 5 years later and you end up paying fees for the next 5 years, so total of 10 years. So many applicants suo moto approached RBI that here I have made a mistake in this case and this is my accepting of my mistake and I want to undertake compounding. So how do you judge the compounding fee? It is based on multiple factors. One is the undue gains made from that contravention, lost cost to the exchequer, economic benefit from the delay or from non-compliance, the repetitive nature of the contravention as well, because if you keep making the same contravention again, you are doing something on purpose, track record and history of non-compliance, and the contravener's conduct in undertaking the transaction. If there is actual malified intent behind that contravention, if you can actually see financial planning, if you feel that, if the RBI feels that there's some planning undertaken behind, a contravention, even that is actually taken into consideration. The guidance matrix, I will explain that in detail, and it's in the next slides and it's provided here. So they have now broken up this matrix and the way of calculating the formula that they have provided is now sort of loosely broken up into reporting contraventions and other substantive contraventions. So for reporting contraventions, they again have broken it up a bit more, but it is mainly broken up into reporting, which is reporting under FEMA 20, FEMA 3, that is ECB, FEMA 120, that is RBI, and other reporting contraventions. Here they sort of have the variable amount is based on a per year amount, but based on the amount of investment involved with a fixed amount of 10,000. So if I have an investment that came in of maybe just 1 crore, that would fall under this 10 to 40 to 100, and it would be a 10,000 plus 10,000 per year depending on the number of years you delayed your reporting. For LOBO, they have put a ceiling of 2 lakhs in case of project office, or in other cases, in case of project office is 10% of the project cost, or in LO and BO, it is a ceiling of 2 lakhs. Also, it would have been covered in ODI that you have other filings such as annual filing of APR, annual filing of FLA, or you also have the requirement to submit proof of investment in share certificates. These are, so share certificate is sort of a one-time compliance proof of investment. APR, FLA are annual compliances. So for those sort of compliances, they have provided 10,000 per return or 10,000 per certificate as the compounding formula. In other cases where you have, this is sort of a substantive contravention, but not very as substantive as they would want it to be. So in this case, where you make a delay in allotment of shares in case of FDI, there are, mind you, out of the 2,600 cases that we saw, probably 700 cases are para 8, that is delay in allotment of this shares. Sushil, you wanted to add something? So in this case, they have a slightly lower minimum formula of 30,000 plus yearly percentage, which actually are not very high, to be frank, which is 0.30 and up to highest of 0.75% of the investment amount. The main contravention where, other than these reporting contraventions and other than corporate guarantee, where most of the contraventions fall, is under this fourth one, where the formula is a minimum of 50,000 plus a percentage depending on the number of years involved in the contravention. Again, any questions, please feel free. This was the formula table that RBI themselves have provided, which gives us an approximation. Mind you, RBI has very clearly clarified that this is only an indication on the basis of which the amount is imposed. It does not mean that it will point to point match this indication. Plus, they will take these factors which I mentioned here in this slide into consideration. If they really do feel that these factors are in play, if the person is undertaking certain kind of financial planning, certain malified intentions are in play, etc., there is also a possibility that they may increase the amount of compounding fee, but this is sort of the minimum amount that is generally charged according to this matrix. In any case, you have the limit, which I mentioned again in my first slide itself, that the limit of 300% of the amount of contravention. So 3 times the amount is anyway the top limit that would be applied. They have certain other limits, internal limits, which again would apply case to case. I do not want to go through each and every one of them specifically, but maybe in short, where if the amount of contravention itself is very minor, such as if it's less than 1 lakh, rather than applying the formula of the matrix, they just apply a simple interest of 5%. In case it's amount, it's a substantive contravention, or 5% in case of reporting contravention and 10% in case of substantive contraventions. Undue gains, and I have covered one case of undue gains in my later slides, where I have taken ECB as an example. Undue gains is where you undertake a transaction which you are not allowed to, and because you undertook the transaction you are not allowed to, you made a gain. By gain, I mean you made money or you made profit that you shouldn't have made in the first place because you were not allowed to undertake that transaction. That is what undue gains is, again in layman terms. And RBI has the right to neutralize that as well. So that profit is also what they charge as compounding fee. There are examples provided by RBI when they came out with this computation matrix. And also there are certain cases that we have come across where they have specifically charged undue gains, and it's mainly in the cases of ECB, in the cases of movable property, where certain, where firstly large amounts are involved, plus when there are transactions where you make gains, like for example, you take loans you are not allowed to take in the first place because you took certain loans which you are not allowed to take. You utilize that amount to make other gains, and that is why they need to neutralize that gain that you made. Or in properties as well, you made a capital gain, for example, they neutralize that gain that you made. Anyway, going forward, this is sort of the background on how the process of compounding is undertaken. Some of the other speakers would have mentioned late submission fee to you. That process has recently come in 2017 in the case of FDI, in certain cases of FDI, that is for form FCGPR, FCTRS. And then recently in 2019, it was also activated for ECB. And that is for transactions that happened after the date that LSF, that is late submission fee, was allowed for these transactions. It is, how do I say, it is an option available that you can pay late submission fee instead of undertaking compounding procedure. It is one or the other. So if you pay a late submission fee, and again, late submission fee, they have a fixed formula provided. How that is calculated, you pay it at the time of undertaking the actual reporting itself. It's similar to how we pay 234 ABC in income tax. So something similar. It's not the same thing, of course. Please don't take me wrong. Something similar to that. You pay the late submission fee, and if you pay that, you do not need to undertake this entire compounding procedure. It is helpful in the sense that you save on time, but it is better to undertake a cost benefit analysis depending on the delay involved, depending on the quantum of investment involved, etc., because there are formulas available in both of them. Because it could be possible that depending on this computation matrix, you may end up paying a fixed fee. For example, if it's a small amount and you go under this reporting contravention or delay in reporting 1, and if it's a small amount, you may just pay 1,000 rupees per year, 2,000 rupees per year plus the minimum amount under this. But the formula under late submission fee might turn out to bring out a large amount, or vice versa. It could be a much larger amount here because your variable amount may turn out to be much higher, whereas under late submission fee, it could be lower. So it's better to undertake sort of a cost benefit analysis with the LSF. So this would sort of bring me to the end of the procedure related to compounding. I can take a 30-second water break while I will welcome any questions here relating to procedures before now I start any cases or the cases related to compounding that we have analyzed.
Tanvi, we have only one question so far.
Sure.
And it says at the time of filing FCGPR, often we understand AD banker insists for valuation report of a date not older than 3 months. Is there any formal RBI circular notification inter-office memo that support this stand? This is asked by Dinesh S. Chawla.
So officially in the earlier 2020 there was no time limit that was given. Yes, there were, I think, operational guidance internally, and banks themselves would take a stand. But I think 6 months was a better stand than 3 months. But yes, we have some very intelligent banks that would insist on the most recent, sometimes 3 months. Sometimes they would insist on undertaking, audit as of the last month ending and then undertake a valuation of that month. But if I remember correctly, I think the recent rules do plan to mention that it should not be older than 6 months. So the valuation report should not be older than 6 months.
Yeah, okay. Actually, justification what bankers normally give is like, okay, there are chances that the valuation may change because there is an investment, there is a foreign investment in the company. And also probably they come up with their own interpretation of the timeline. You're right, like sometimes they ask of very current date or ideally, yeah, obviously the valuation doesn't change much if we are taking for 3 to 6 months. Yeah.
And so if you have multiple tranches of investments coming in, sometimes they do require it often, because you could have pre-money, post-money, valuations changing often. But if it's one-off investment that has come in maybe 6 months, and then you have a new tranche coming in, you could probably convince them that there's not much change. Again, if there is a DCF being applied, maybe there's a chance of it continuing to apply the same, but if NAV, then maybe not, because of course your internal financials itself change post money. It really depends bank to bank, but there is no clear RBI circular in this, except for the recent one where it says that it should not be more than 6 months old.
Okay.
So any more questions on the process part of it? Then otherwise we can go ahead with.
You can proceed. I'll let you know in case there are more questions on this subject.
We are already slow on. I'm late on my timeline that I was hoping, so I think I will try to hurry a little bit. What I'll maybe do here also, because I have almost, I think, 12 or 13 cases in FDI and almost 13-14 cases in ODI. Maybe I will run through some of the smaller ones, or maybe even skip through, because we have only 1 hour left. And if time permits, then I will come back to some of them. There is a question by Aparna. Aparna, yes, there is a formula provided in that for the late submission fee also. I did not include it in my PPT. You will find it in the master direction on reporting, or if you can just get back to me offline, I will provide it to you. And one more question.
We discussed the LSF part in the last session, so there wasn't matrix shared with them, so they can refer to the last presentation.
LSF in case of FDI is not applicable to past transactions in case of transactions that happened before 2017. But in case of ODI, in the draft rules that have come in, although the final rules have not yet come in, the LSF part of it is worded in such a way that there is a possibility that past 3 years transactions may also be covered under LSF. But again, it is still in draft stage. ODI, the final rules are not out yet. So that's only a possibility that could happen. But as of today, nothing in the past is possible under LSF, only future transactions.
There are a few more, so would you prefer to take them now or probably after that?
I think covered related to procedures would be preferable just now quickly, and then maybe.
Okay. So Sabni Sunil Arvind says, is there any filing fee to be paid along with submission of compounding application?
Yes, there's a 5,000 submission. I did not mention that. My bad. There is 5,000. I'm suddenly 5,000 rupee submission fee payable, and let me just recheck.
Yes, it's 5,000 rupees.
Yeah. Why didn't I mention that? I'm a little confused.
Next question is again, Aparna, is there any method to apply for waiver of late submission fee for FCGPR due to rejection of original form filled within due date?
No. So for LSF, no official this thing waiver. If you think you might be able to fight it, if RBI may take your side that you actually filed it within the original date, then you don't pay LSF, go for compounding, and there you submit proofs that I filed it within the date. So you have to have acknowledged copy. You have to have reasons why that copy was not, the final form was not actually processed, and it was the bank's fault. So in fact, again, I have certain cases I have covered where if it is, there are cases where the form was filed by the person on time. The bank forgot to file it with RBI, and still the person had to undergo compounding for delay. But there is also another case where the delay was due to bank and not due to the applicant, and the RBI took a stand that it was okay, and since the applicant had filed it in time, there was no issue. So there are cases on both sides. It would then happen what comes in your favor. But then you have to be sure of your stand. You have to be sure of all your documentations, and also then there is a possibility it might not be in your favor, and you might have to end up paying the compounding fee. So if the LSF amount is very small, you might as well just pay it. Again, cost benefit analysis.
Yeah, that's right. Another one is from Anshu. She says, there is a time limit for which the authorities will issue a compounding order if an amount involved is very little, say INR 100, but it is related to year 2014-15. Can LSF be applicable, or do we need to file a compounding application?
So once the application is filed, etc., the actual time limit, like I mentioned, is within 180 days. But right now there have been slight delays due to the whole COVID backlog happening. But still kind of the 180 days is being followed, a couple of days or a month here or there. Sometimes yes, but or maybe not a month, count 2 months up or down. If the amount involved is very little, say 100, there are cases where RBI itself will send a memo saying that it's okay, it's a very small amount. You do not need to go for compounding, but to be on the safer side, you can go for it. You might fall under I mentioned in the compounding matrix, at the end of it was mentioned that if the amount is below 2 lakhs, the compounding fee would be based on simple interest. You might fall under that, and again, the amount would be pretty small. But to be on the safer side, it's better to file the application. LSF for 2014-2015, not possible, like I mentioned already. It's for FDI for after 2017, for ECB after 2019, after both of them got.
Yeah, there are cases where the RBI may only issue a warning letter kind of thing.
Yes.
to the entity.
Yes.
Where the offense involved seems to be, you can say, justified, or delay seems to be justified. They just end up issuing warning letter kind of thing.
Or they sort of only acknowledge the contravention and say that, okay, we understand this contravention has happened. Don't
do it again.
Yeah.
Okay. I think you can proceed. There is no further questions. Participants, please feel free to add on the questions. We'll take them up as of now, or probably just after, once Tanvi finishes this analysis of compounding orders.
Yep. So I'll first start with, why is it not moving? So sorry, contravention of the FDI regulations. So the first one, Mr. Muthukumar Ayarpade. So again, these are the cases which I've covered is from the cases that we could analyze from the period between that were issued between 2016 and 2020, which came in the public domain. So you might find most of them related to FEMA 20 or 20R, because after that, NDI came in after that. And of course, if there are also cases that have already gone to compounding for NDI, they are coming in the summary format, and we don't know much details to have a complete analysis of those contraventions. But of course, if someone has done an analysis, a lot of the regulations have been carrying forward from 20 to 20R to NDI. So a lot of, at least the interpretation of it will continue to apply. And plus, when you are doing compounding for past cases, these cases will continue to help going forward also. So it is important to have a look at most of these past cases as well. So Mr. Muthukumar Ayarpade, I apologize if I am pronouncing it wrong. So in this case, I will go to the next slide and then so in order to explain it. So the Mr. Muthukumar was an NRI applicant. So the applicant in the first, so he was the one who undertook applicant. Again, so he was the one that had the contravention. He was an NRI applicant. He intended to acquire stake in an Indian company, that is SAPL. Let's not go into the names. For the purpose of understanding, I have mentioned names here, but he wanted to invest in an Indian company through another Indian company. So the first leg, Mr. MA, who is non-resident, his plan was to invest in AHPL, in SAPL through AHPL. He infused funds in AHPL through his NRE account. But however, his business plans changed and he decided to structure this investment in a different way. And he decided to set up a holding company outside India rather than inside India. So these funds, which were already in AHPL, were then used for payments towards SAPL from resident shareholders and for other indirect payments to SAPL. So what happened was these payments were not used for what it was intended, plus it was used as an indirect method of investment. Also, part of such consideration was paid over a period of 1 year on deferred payment basis without RBI approval. Later on, the applicant transferred the shares to another non-resident entity. So non-resident, NRI. So NRI individual transferred it to another NR. So it was an NRI to NR transfer without the approval of RBI. Again, the regulations mentioned here are under FEMA 20. So the numbers, some of them, if you're trying to match them with India, obviously they may not match. But so here, which is the relevant regulation that is under play? It is Regulation 3. What is Regulation 3? It applies to non-residents. It is the general prohibiting regulation applying to non-residents and restricting them from acquiring or transferring Indian securities. Whereas Regulation 4 applies to the Indian entities. So in this case, we don't look at the Regulation 4, we look at Regulation 3. So after going through the facts, I think these charts make it much better and clear. So what are the takeaways that I wanted to bring out from this? Firstly, RBI granted post facto approval for the transfer of shares from NRI to NR. This is the regularization that I mentioned. So if you go back to the prerequisite that I mentioned before going for compounding, you need to correct the mistake that you undertook. He did not take approval for the transfer of shares, which was required. Now he has taken that approval and he was granted that post facto approval. So therefore, the regularization has been undertaken. What are the two contraventions that I mentioned? One was third-party payments, and the second was deferred payments. First, going into third-party payments, the sale consideration was routed to third parties instead of directly to the resident sellers. So then go into these facts. When these sales happen, he paid these third-party sellers through AHPL rather than he paying it himself. So just for the information of everyone, when there is different when there are two non-residents involved and the money is coming from another third party non-resident, this is permitted under the user manual under SMF and subject to conditions that the KYC for both of them is required, etc., etc. But in this case, what went wrong was one of them, that is AHPL was also a resident, and that is where this transaction was in contravention. And also the SMF manual was recently came in, and it was obviously not permitted at that time. Deferred payments, this transaction when it was undertaken was not permitted. Now, as of today, deferred payments is permitted up to 20, subject to a maximum limit of 25% for up to 18 months. And also to mention, I have not covered it in my slides, but the resident sellers, these sellers who sold the shares to Muthukumar Ayarpade, they were also separately compounded for receiving the sale consideration on deferred payment basis. They were not allowed to receive the sale consideration on deferred payment basis. They did so, and therefore they were also subject to compounding. So this is very important to remember that in a transaction that involves two sides to a party, both sides could be compounded for the same transaction depending on who is contravening which provision. And also, it does not mean that it's not double jeopardy. It could be double jeopardy if Mr. Muthukumar was being compounded for the same contravention twice, but that is not the case here. It is the same transaction. Both different parties are being compounded for different contraventions. They are being compounded for receiving on deferred payment basis, and Mr. Muthukumar is being compounded for paying on deferred basis. I hope that clears what I'm trying to bring forward. The next case here is Guterman India Private Limited. Under the facts of this case, again, not going into the specifics of it, there were multiple inward remittances that came between 2005 to 2009. 419,000 shares were allotted against the value of so-and-so shares for the funds payable towards the asset transferred by the non-resident entity. So what had happened was there was another entity that had a LOBO in India. They shut down that LO, and when they shut down the LO, they transferred all the remaining assets to the applicant, that is Guterman India. So the transfer of those assets and the value against those assets, that they issued shares against those assets. That was not a permitted investment, a mode of investment that is allowed to be received, and therefore the applicant was compounded and was required to go for compounding. Here also, we are not aware whether the company that had undertook the closure was also compounded, because again we have a very small period of cases available to us, because it could have been compounded before or after the cases are available to us. But that entity that undertook the closure of the license office and did not take back the assets, that entity also would probably have been compounded separately under the LOBOPO provisions under FEMA. So this Prestige Garden is something I'll maybe take a couple more minutes to cover, is because this is a case that is very common and very often that comes across a lot of consultants. This is a case where a resident shareholder transferred shares to a non-resident. So it is a resident to non-resident transfer of shares. The resident received the consideration and the transfer took place in July 2015. However, the transfer in FCTRS was reported in October 2017, and at that time, approval was required for this transfer, which was taken in December 2017. So what are the two regulations involved in this case? Regulation 4, which is taking on record the transfer of shares. Regulation 4, mind you, the way it is worded, applies to the Indian entity for taking transactions on record. Yeah. So here, in my view, Regulation 4 is correctly applied to Prestige Garden constructions because they took the transfer on record before it was reported to RBI, because the transfer was recorded in July 2015, but it was reported to RBI in October 2017. So being compounded under Regulation 4, in my view, is correct. However, if you see in this order, we have also been compounded under Regulation 10AB1, that is the delay in reporting. And the 10AB is the regulation that deals with transfer, read with para 10, which is para 10 of Schedule 1, is the regulation which deals with the reporting requirement for transfer in form FCTRS. What does for para 10 mention? Who has the onus of filing? The onus of filing is on either the resident or the non-resident transferor or transferee, but the person who is resident in India. So if it is a resident to non-resident transfer, the resident is the transferor. That person is required to file form FCTRS. If it's vice versa, the transferee is resident, FCTRS is required to be filed by the transferee. So then in that case, my question here is, why is para 10, regulation 10 read with para 10 applied to the company? Shouldn't it be applied to the resident shareholder? And here in this case, it has been applied to both. Both the regulations have been applied. So does that mean that compounding fees have been levied twice? So this is just a point to ponder I have wanting to bring out here. And this is where the knowledge of FEMA is important as a consultant, where if you are going for compounding of a simple transaction as a delay in reporting of a transfer, if you are going on behalf of a company, you have to be sure that they are not being compounded, or they are not being compounded for the actual filing of the form, but they are being compounded for the taking on record of non-filing without or delay in filing. And this is where it's important that the right regulation is being applied to the right applicant. And they're not ending up paying double the compounding fees, which has happened in this case. MQR Pharmaceuticals. For now, it's a case about ESOP. I will maybe cover it very quickly or skip for now. Because in case of MQR, it is a case of ESOP where the applicant issued multiple ESOPs, 1,65,000 ESOPs, which could have been converted to those many shares, and these were issued to 13 non-resident employees. However, this was done without FIPB approval. At that time, FIPB approval was not required. Now the board has changed to FIFP, but it's the same board. Names have changed. What is the point here is what had happened was, by the time when the actual compounding happened, or when the actual approval was taken, the delayed approval, 6 of the 13 employees had actually left the company. And so therefore, even if there was a the actual exercise of the ESOPs had not happened, but even if there was a possibility to exercise the ESOPs, not all 165 ESOPs could have been exercised, but only 55,000 ESOPs could have been exercised. So do you compound the entire 165 ESOPs, the delay in that, or only the 55,000? Because the actual remaining 1,10,000 are actually not even possible to be granted or exercised anymore. So the point here is that FAQ to the FDI rules has made this very clear, that what percentage of foreign hold, when do you calculate the percentage of foreign investment, and at what stage do you calculate it? Is it at the vesting stage or at the exercise stage? And here RBI has made it very clear that it is calculated on a fully diluted basis at the time of issuance of ESOP. And therefore, in this case too, since at the time of issuance of ESOPs, the issuance was of 165 ESOPs, the entire 165 was what was subject to compounding, and not only what was granted or exercised at a later stage. In this case, Apollo Cosmetic. So again here, why I have mentioned 2 names is because Apollo Cosmetic Surgical Center was the actual entity that received the investment. However, it was taken over, it was acquired by another entity, that is Apollo Health Lifestyle. And because at the time of compounding, the original company did not exist anymore, therefore the actual application was done by Apollo Health Lifestyle for this, and therefore 2 names are mentioned in this case. So in this case, again, not going, just to save time, what happened was inward remittance was received from an NRI, but they were not able to allot shares to this NRI because that for some reason the NRI was not traceable, and because they were not able to allot the shares, nor were they able to refund the share application money to that person, because after they received the money, that person was not traceable, nothing was possible. By the time this entity was acquired by Apollo Health Lifestyle, another entity, pursuant to High Court order, etc., the normal whatever process that took place. After all this, the 7-year period passed, which is required under the Companies Act, and because the 7-year period passed and the share application money remained unclaimed, they transferred this amount to the investor education and promotion fund. So my only point to ponder here is, the applicant tried their best to do everything. They tried to find the person, they tried to refund the money also, they were okay with allotting the shares. There was an impossibility of performance. Even in such a case, they had to undertake compounding or delay in issue of shares or refund of share application money. So can you in any case take a stand that there was an impossibility of performance and ask for leniency? I mean, I don't know whether they tried that or did not try that, because that is not mentioned in the order. But again, being a compounding order where you just go and accept your mistake, this is what happened. But just a point to ponder here, that whether there's any kind of possibility that RBI would say that, okay, we won't compound you. We can maybe approach RBI and ask them if that's possible. Because there was no possibility to unwind the transaction at all. They tried their best. Sorry. I'm skipping some cases for now, which yeah. So in this case, there is a separate transaction that, a separate regulation 10AA1 that deals with gift transfer of shares by way of gift from a resident to a non-resident. And this regulation is under approval route. And not only that, then it has sub-regulations that has certain limits attached to it. And the limits deal with percentage of paid up equity capital, value of the investment, etc. There's certain attached conditions. So in this case, what had happened, the applicant was a resident and he transferred shares to a non-resident. And this transfer was undertaken without the approval of RBI. And also they provided in the facts of the case that it exceeded the value of 5% of the paid up capital and also exceeded the rupee equivalent of USD 25,000. Again, I have just listed down the relevant regulations that we will discuss here, which I mentioned already. That is the approval and the 5% of paid up capital, and also the annual limit of 25,000 USD. So there are two possibilities that I thought of and I wanted to bring out, and this is where we need to apply our minds to almost all substantive regulations, which is where you consult your client in the first place also. That firstly, 10AA is the heading of the regulation, and then the others are sub conditions attached to that, such as the 5% limit, the threshold, the 25,000 threshold, etc. So can you say that the main contravention, the main 10A regulation was is what you apply and you compound that? That is the contravention that happened. On the subsequent and sub conditions are subsumed within that main regulation. This is generally what is followed under ECB. That in ECB, you did not comply with the main regulation 6 of ECB. And then all the other conditions, that is the recognized lender, recognized borrower, etc., those are subsumed within the main regulation 6. Whereas, or do you apply each of them separately? That I did not take approval, that is a separate contravention. But now within that approval also, I did not comply with this threshold of 5%. So that is a separate contravention. My threshold of 25,000 got exceeded. Therefore, that was a separate contravention. So this is where it's a matter of convincing the officer, where you can maybe probably try to convince him that the main condition of the approval itself was not complied with, and all the others get subsumed within that condition, and therefore only one contravention has happened of the main heading or the main top head regulation. What RBI has applied in this case is that they have compounded each condition separately. My presumption in this case is why they have applied each of them separately is that even if RBI approval was obtained, but the other conditions were not complied, you would have had to comply with, you would have had to compound for those other conditions. But you could also again negate that by saying RBI approval would not have been given only if the other conditions were not complied with. So you have a to and fro in both sides. Also, just another point to bring out here is when the transaction actually happened, that was in, I haven't mentioned the date exactly. Yeah, it was somewhere before 2011 when the transaction happened. In this 10A2E, the limit was 25,000 USD. That the security amount transferred should not exceed 25,000 USD. However, there was a circular on 15th September 2011 where this was liberalized to 50,000. So can you say that from the date of the transaction, until 15th September, you compound in excess of 25,000. But from 15th September until the date of compounding, because your amount has been liberalized, then the compounding amount should be only in excess of 50,000. Are you getting, I mean, I hope you are understanding what I'm saying. Since now my threshold has increased, my amount of contravention, the mistake that I have made, should also reduce. Relicis medical devices is another case. It was an interesting one. And in fact, there are two cases in case of Relicis. And so I've covered them side by side. They are not on the same contravention, and therefore the 3 years cooling off period does not apply in this case. Otherwise, if they were on the same contravention, the same, they would not have been able to go for compounding, because again, that was a prerequisite, if you remember, one of my first few slides. So the applicant had issued CCDs, and the CCDs were converted in 2013 into equity shares at the price lower than the value of share determined at the time of the issuance of CCD. And because it was converted at a price lower, it resulted in excess allotment of shares. Because it resulted in excess allotment, they were required to cancel this excess allotment by the NCLAT. That was the first case. And in the second case, the facts were that the applicant refunded unallotted share application money. And in this case, what they paid was, they paid an interest along with that share application money. And this was in compliance of Companies Act. I mean, people who are well versed with Companies Act, for them, this is very normal. But please remember, in Companies Act, this is very normal, but this is not permitted automatically under FEMA, and it is subject to compounding, which this is an example. I will, again, in my next slide, I will explain to you when it is permitted, when it is not. But please remember, it is something that is automatically applicable under FEMA. It may sound very normal under Companies Act, and it is very normal under Companies Act. In fact, it's a requirement under Companies Act. But under FEMA, you have to be careful. In this case, the RBI advised the client to unwind the transaction by bringing back the money. So this is again part of the regularization. To regularize their mistake, they were asked to bring back this interest amount. So explaining both the contraventions that happened here. So again, in FDI, you would have been explained the pricing guidelines when FDI was covered yesterday. So when in case of convertible instruments, it has been mentioned that convertible the the price or the formula, conversion formula in case of convertible instruments should be determined upfront. So if I'm issuing CCDs today, as of today only, I have to determine either the conversion formula or the price at the time of issuance of the CCDs. And it should not be lower than the value worked out today. So in this case, what had happened was when they actually converted the CCDs to equity shares, they converted it at a price lower than the fair value, and which was the mistake that they made. In another case, it was not related to conversion, but just an example to bring out where you have certain pricing guidelines related mistakes. What is another way of regularization that could happen? So in this case, they were required to cancel the shares. In another case, if there was a shortfall, so pricing guidelines were not complied with and less money was received into India, RBI can require you to receive that shortfall as part of regularization. And this was I have it in my notes. There are a couple of cases. In the case of Karadi Path Education, they were required to bring this shortfall specifically into India. And in case of interest, so like I mentioned, 42(6) of Companies Act is very, which normally it's regularly applied. It requires payment of interest for delayed refund of share application money. But under FEMA, when there is a foreign investor involved, such interest payment is not possible under FEMA 20. Under 20R, there was a proviso that mentioned that this payment can be made, but it can be made with prior approval of RBI. This proviso has not been included in NDI rules or the mode of payment or this thing of the non-debt instrument regulations. But of course, that means that interest payment is under approval. So either you cannot make the payment, or if you want to only make the payment, if it's part of your structuring with your investor, if you need to make the payment, it is with the approval of the RBI. It's better not to include it in your structure, but if you do, please take RBI approval or you will be required to bring it back. LSF I have already covered, so I'm skipping this case for now. It was a case where the client for the year 17-18 chose to opt for LSF rather than to opt for compounding. Although in the case of FLA, compounding fee is very less of 10,000. Anyway, I'll move forward because I need to save on time. Shri Paturi Srinivas, in this case, this is one of the few 20R cases that I found important. Many of them are again related to reporting. It would be a waste of time, and they are available in our books. If you are interested, you can purchase our books or contact me offline. We have listed all of the cases, and some of them relate to reporting, some of them related to other substantive contraventions, and one of them in this case, Mr. Paturi, he was a resident and he had shares which he transferred to a non-resident in Singapore. So resident to a non-resident transfer. And what happened was he received excess consideration and he placed a request to refund this excess sales consideration. So it is a normal case where the sale took place, a transfer of shares took place, but rather than receiving 100 for that sale, he received 120. So he needs to actually transfer the 20 rupees back. He received 20 in excess. If you read Regulation 1314, it is the timeline only for filing of FCTRs. There is no timeline with respect to time within which the amount needs to be received, the time within which the amount needs to be paid, etc., etc. And I am equating this to the issue of shares provision, where you have which would have been covered in the FDIQ, where you have to, for example, receive the money within so and so days. Once you have received the money, you have to issue the shares within 60 days. If you do not issue it within 60 days, then you have another 15 days to refund that share application money. You know, you have a fixed timeline. In this case, there is no fixed timeline in how many days to receive it and how many days to either receive or refund or etc. The only timeline is with respect to filing form FCTRS. In this case, what is interesting is this FCTRS timeline has been also equated or has also been utilized as the timeline to refund that excess amount. And since the person did not refund it within the 60 days, he has been subject to to compounding. Let us maybe take an example that if he actually refunded it within the 60 days, he wouldn't have been subject to compounding problem. But here in this case, just to bring out, although it's a transaction after 2017, because this relates to refund and not the actual reporting, he could not opt for late submission fee, but had to undertake compounding. There was a similar case even in FEMA 20, which is in the case of Capricorn Group Private Limited, where refund was not within 60 days and therefore they were required to undertake compounding. So in contrast to this previous case that I covered, in this case, the applicant was a resident individual and transferred shares to a non-resident. In this case also, he received money in excess. So the consideration received was in excess, and he sought RBI approval for refund of the excess money, and he refunded it on approval after taking approval of the RBI. So here, what they have applied, rather than applying just the, so in this case, in Paturi Srinivas Rao case, like I explained to you, he applied the 60 days limit, which is the 60 days limit for FCTRs. In this case, funnily enough, what they have applied is, rather than applying, it's a transfer case. I've mentioned the facts to you. It's a case of transfer. It's not a case of fresh issue, where fresh issue you issue shares within 60 days or refund within another additional 15 days, etc., etc. But they have applied the time limit relating to fresh issue. That is, you issue, that is the 75 days limit. So in similar facts, different approaches have been followed. And this is where, again, analysis of compounding orders is an important study in itself. My personal view is the Paturi Srinivas is the right approach. But if you were to see 75 days is more beneficial. So if your case is in the time, in the very limit of that timeline, you can maybe take help of this case and try to convince an officer. But the safer bet would be the Paturi Srinivas case. So this brings me to an end of the FDI cases. I'll move to the ODI cases. Any questions in FDI? Maybe I can take it up in 2 minutes. Okay, I'll move forward. So R. Ramanujan, and here there were multiple cases of the Ramanujan family. So for the purpose of the whole picture, in this ODI case, I will cover 3 of them together. R. Ramanujan, Prema Ramanujan, and Sumanath Ramanujan. In this case, all 3 were resident applicants. What they did was, in 2010, R. Ramanujan remitted amounts in an overseas JV in Singapore and subscribed to equity shares. And this was done under LRS, which was not permitted. I think LRS is one topic that I think you all have it tomorrow or day after. I'm not aware exactly. But again, it will be covered in that. And if ODI has already been covered with you guys, ODI under LRS was permitted with effect from 5th August 2013. Cases of ODI before that by individuals, resident individuals, are subject to compounding. So when I say that if any cases here, if I mention that if they are before August 2013, and I say that it was under LRS and not permitted, it means that it was not permitted under ODI LRS. So, and also in this case, not only that, the JV was not an operating entity, and an additional fact is that in 2015, so after we had already acquired all these shares, etc., in 2015, R. Ramanujan gifted these shares to Sumant Ramanujan. And similarly, in Prema and Sumant's facts of the case, they were also resident individuals who remitted amounts in 2017, even before Mr. R. Ramanujan, to the Singapore entity. And this was also under LRS when they were not permitted to do so. And as I mentioned in the above facts, Mr. Sumant also received shares as a gift from R. Ramanujan. And an additional fact is that in 2017, so after all the above transactions were done and all, 2017, both these persons divested their stakes in favor of another Indian entity before taking any kind of approval from RBI or even applying for a UIN number. That is before regularizing their investment. So what are the contraventions they undertook and what are the takeaways from this case? So like I mentioned, all 3 of them, of course, were not permitted to undertake ODI LRS. That is investment under Schedule 5, that read with Regulation 20A, because this was all prior to 5th August 2013, and therefore they were compounded under the said regulation. But what has happened is, if you see the orders, only R. Ramanujan, in his case, this regulation C1, that's the first one, was not mentioned. And the only reason that is because he probably divested his stake even before the whole approval was taken. Because C1, why I mentioned C1 is deals with permitted modes of disinvestment. And he undertook a mode of disinvestment that was permitted, that is sale by gift. In this case, RBI neutralizes the undue gains that the applicant may have got. Again, I mentioned in my earlier slides that if you undertake a transaction and you make any gains from the transaction that you are not allowed to make in the first place, those undue gains need to be neutralized by the RBI. All these three persons invested in a Singapore entity and they were not permitted to do so, and they made profits out of that entity, and therefore those profits needed to be, those gains needed to be neutralized, and which was done by the RBI under this order. Girendra Baburao Kasmalkar. This was also another interesting case because what happened in this case was the applicant and along with another applicant, so it was a similar fact pattern in two applicants. Both were resident individuals. They founded two Indian companies. What happened was another overseas company, they were not involved in the first place with that overseas company. Another overseas company, which is listed in Germany, acquired their two Indian companies. But as a form of compensation to acquire these two companies, the applicant received shares of the two of the overseas entity. So it was a swap of shares. The transaction was reversed because post facto approval was denied by FIFP. So in the first place, swap of shares is a permissible method of funding under ODI regulations. So I'm not saying that is not permissible, but why FIFP approval is required? Because what happens is in most cases of a swap, in the case of foreign swap, the swap would result in an ODI FDI structure. Because if an Indian person is swapping shares of an Indian entity for shares of an overseas entity, it would end up holding shares of an overseas entity. That overseas entity would hold shares of an Indian entity. So you're having a round tripping structure that results because of that swap. So because you have an ODI FDI round tripping structure happening, the FDI leg will always require the FIFP approval. And in this case, the FIFP approval was not taken. When they went and approached FIFP for post facto approval, they were denied that approval and therefore regularization. RIR also is a case where the RBI has not been lenient. This was a case where I mentioned to you that when I was covering the computation matrix, where RBI really takes into consideration the factors that they have mentioned. Because this is the case, they very much were of the view that they should not be lenient, and it was very visible that there was actual financial engineering involved in this transaction. So what happened was in this case, RIR International is a Mauritius entity and was a WOS of the applicant. The applicant issued corporate as well as personal guarantees on behalf of its WOS to ICICI Bahrain. And with the help of these corporate and personal guarantees, the wholly owned subsidiary could raise other loans. The financial commitment, because of these corporate guarantees, exceeded the 400% net worth of the applicant. And the WS invested the proceeds in CCPS of another Indian entity. So before I go into the takeaways, just a bird's eye view of this. I'm not again going into the numerics of this because we again don't have the time. But this was the entire financial engineering that happened, that RIR firm, Indian partnership firm, gave corporate guarantee to a Bahrain bank in favor of its WOS in Mauritius, which invested in another Indian company. And also the directors of this company, as well as the partners in RIR, were the same. So there was a clear case of financial planning involved. What RBI took a stand in this case was, they neutralized the undue gains that arised from round tripping. And how they neutralize this? This is an example of the neutralization of undue gains. They neutralize the gains by the difference between the CCPS coupon rate and they reduced the PLR rate. In my view, what could have also been an alternate way of computing the undue gains could have been the difference in the interest rate at which the wholly owned subsidiary got the loan less the coupon rate. So this could have been another alternative way of neutralizing the undue gains. The RBI also returned the application, to the after referring the matter to the ED because they had certain doubts of money laundering, etc., happening in this case. However, the applicant filed a petition before the High Court, and the High Court disposed the petition and directed the RBI to complete the process of compounding. So this again was in favor of RBI at least. So in this case, at least in case of the late filing fees, not with regard to the round tripping part of it, the RBI, the applicant tried to plead with the RBI saying that the AD bank did not guide them appropriately. But however, the RBI stated very clearly that their argument was not sustainable, and the onus, and this is, mind you, applicable in every case, the smallest or the largest, that the onus lies on the applicant to comply with FEMA. You cannot blame the bank in case of any kind of filing delays. You read any regulation under FEMA, the person undertaking the transaction is required to comply with FEMA. It does not say bank needs to file this, bank needs to file that. There are cases where forms need to be filed by bank, but then in that case, the onus of filing that is also with the bank and not with the entity involved. And here the RBI rejected the plea of leniency because there was clear case of financial engineering, like I mentioned.
Tanvi, we are already at 5:57. So should we take further questions and probably try to wrap up if there are questions from the participants?
I'll do that. Yeah, by the time I'll just go through if any, really important case that
Okay.
I should cover, and I'll also just take up the questions.
Sure.
I think this also some of. This is one of the cases I mentioned earlier. This will help clients. I will not go through the facts. I'll only just cover the takeaways. This is a case where the applicant had filed the ODI forms, etc., with the bank, but the bank did not forward that to the RBI. And even though the bank made the mistake of not forwarding them to RBI, still the applicant was held liable for non-compliance and they were subject to compounding. But there was another case, in the case of Atul Limited, where applicants submitted copies of the acknowledged forms of the letters, etc., that they had filed everything on time. And then in that case, it was not considered as a contravention of delay. So I think someone had earlier asked a question, and then these two cases would probably help them. I mean, both sides, they're both sides of the spectrum. Whichever one helps them would, be in their view. I will be sharing the presentation. So if some of them, I have covered in detail in the slides only. But, another case, in certain cases, this is also another case where you sometimes have capitalization of outstanding amounts or capitalization of pre-incorporation expenses, etc. Generally, from ODI reporting, we always have that in our mind that it is within 30 days of a transaction, etc. Sorry, at the time of making the investment. But we forget that when there is a capitalization happening, also there is a requirement of form ODI. And for that, the limit is within 30 days of the capitalization. And because sometimes the bank is not involved in such cases, when you're just doing a capitalization, it is just a entry in your books of accounts. And bank also might not be aware and they cannot guide you sometimes. So be aware that when you see such a transaction happening of capitalization, that the compliance related to that capitalization is done. And how do you calculate the 30 days in this case? 30 days is from the authorization in the board resolution that we agree to capitalization of so-and-so amount, etc., and issue of shares against this amount. So this is something as an auditor also, it is important to forget as a FEMA consultant, when you're auditing the books of accounts, and if you see capitalization in the books, you should be aware that the FEMA regulations have been complied, especially the parent, or if the capitalization is towards a foreign party.
Tanvi, I would suggest, since these cases are in public domain anyway, so in case any of the participants has any particular issue, they can definitely reach out to you.
Sure.
Yeah. I think there's one question which has been raised by Suresh Jain. It says excess money could be because of exchange rate difference in INR. If permission not granted by RBI within 60 days, then what happens?
So if it's in fact within 60 days, you don't need a permission. You can just return it without any kind of permission. If it is after the period of the 60 plus 15 days, 75, then there is the requirement of RBI approval. And if it's a very minor amount, although it's not officially within the NDI rules, there are internal processes or internal guidelines that have been provided where if it's a very, very minor amount, generally the banks also do not insist on. If the amount is much larger, of course there is a requirement, but if it's like 100 rupees, something, sometimes even banks or RBI let go. Although at the same time, I have seen compounding cases of even 100 rupees and of even, there was a case of literally 10 rupees, I'm not exaggerating. So it's always better to be safe than sorry.
Yeah, rightly said. Yash, can you confirm, are there any further questions from any of the participants, or can we conclude the session for today? Tanvi, in the meantime, you can go to the last your contact details for the benefit of all the participants who are not on Telegram group. These are the details of Tanvi. You can reach out to her in case of any questions. So Yash has confirmed there are no more questions. I must say it's indeed a wonderful session. And I'm sure all the participants would have learned immensely from your knowledge and experience. With this, I, on behalf of Team ICI and the Committee on Economic, Commercial Laws and Economic Advisory, offer you a vote of thanks and appreciate your gesture for this noble cause of knowledge sharing. We look forward for further more sessions on different subjects. I'll also take this opportunity to inform the participants that tomorrow's session is on appeal and arrest under FEMA. And another senior learned faculty advocate, CA Raja G. Valacha, has generously agreed to take this session. We look forward to have you all for the same tomorrow at the same time. With this, we end this session. A lovely and blessed evening to all. Please take care. Thanks a lot.
Thank you, Sushil.
Thank you, Tanvi.